Good evening, ladies and gentlemen. This is Barry Norman on behalf of VTX, and welcome to our webinar on technical analysis. Now, for those of you that are joining us for the first time, ETX is a regulated provider, and therefore I'm required to give you a risk warning. So let me read that and get it out of the way. Trading in the financial markets can result in the loss of the amount invested. Do not trade with funds that you cannot afford to lose, and seek advice if you do not understand the risks. All information is provided in this webinar is for educational purposes only. ETX Capital and the presenter are not financial or investment advisors and do not recommend any securities or instruments of any kind. Any securities or instruments that are mentioned are for educational purposes only. Now, ETX is a fast-growing financial services company, and we are based in London. You can come by and see us if you like. We are authorized and regulated by the FCA, the Financial Conduct Authority, and we're also a member firm of the London Stock Exchange. When you trade with ETX, you have a lot of options. You can trade Forex, commodities, currencies, binary options, spread betting if you're in the UK. It's up to you. Now, we offer many different platforms. If you're a novice trader and want to start out where the risk is minimum, you can use the ETX binary options platform, where your risk is only the dollar amount you type into the screen. Or if you want to move up to the more advanced trading, you have access to our ETX Trader Pro, which is our online trading for CFDs, Forex, commodities, and stocks. And then if you want to move over to the more advanced trading or want a more complicated, more precise platform, you can download our ETX MT4 platform, where you can add on expert advisors. You have advanced charts, and you can also use it to automate some of your trading systems. So you have many choices when you're trading with ETX. If you're interested, just click on or go to etx.com and then look for our customer support button. Click on there and somebody would be glad to help you and explain the differences in the platforms and what is best for you. Now, once you start trading, or if you're already trading, there are two schools of analysis. Many traders are fundamentalists. Fundamental analysis uses things like balance sheets, income statements, cash flow, press releases, news headlines, and economic status, central bank announcements to make trading decisions. Whereas technical analysis uses patterns or patterns seen on charts, or indicators and oscillators that are used in conjunction with price charts. Now, to understand how the market works or learning to get the most out of financial markets, technical analysis will help you trade successfully. Because no matter how much fundamental analysis you use, no matter what kind of earnings statements, no matter what kind of press releases you're looking at, no matter what type of economic event or central bank action you're looking at, none of those, they might tell you that an asset's undervalued and you should be buying it, or an asset's overvalued and you should be selling it, or it might tell you that you have an opportunity to make some money, but none of them will tell you the swing of the marketplace. None of the fundamental analysis would tell you the volatility in the markets, and none will tell you what price points are important as price moves up and down, or how to set your stop loss, take profit points, or how traders have traded at that point in the past. Now, technical analysis is the study of market action, primarily through the use of charts for the purpose of forecasting future price trends. In its purest form, technical analysis considers the actual price behavior of the market or instrument based on the premise that price, the current price of an asset, reflects all the relevant factors before an investor becomes aware of them through other channels. So technical analysis is made up of three assumptions. And these assumptions are not very scientific, but that is, history tends to repeat itself, price moves and trends, and the market discounts everything. Okay. Well, we need to clarify these a bit. History tends to repeat itself. Well, that means if you can find a price pattern or a market action or reaction over the past or in the past using historic data or old historic charts, that it's going to repeat itself in the current trends. I say it's a lot of bunk. I say it needs to be qualified that short-term history tends to repeat itself because the markets have radically changed in the last few years. It used to be you could depend on 10-year-old charts, 20-year-old charts to see how markets reacted. But you have to remember, not long ago, we didn't have online retail trading. We virtually had, PCs haven't been around that long. And the people who have entered the markets have completely changed. We didn't have CFD trading. We didn't have binary options trading. And we had no online Forex trading. You started with some stock trading. So what happened is the makeup of the market has changed tremendously. This means the action and reaction based on the psychological inputs of those people is much different. So I say if you can see price repeating a pattern or a trend it did in the last 5 to 7 years, it might be valid. But going back and looking at how something acted 20 years ago, to me, has no value. Then the next assumption is price moves in trends. And trends are up and down or sideways. And it is very, very true. There's an old adage in the market, the trend is your friend. Price moves in movements upward, and then it moves down. And then it moves up again, and it moves down. And so it tends to move in these patterns. And you can analyze these trends up and down to determine how strong they are, how far they should keep on going, and when they're overvalued or overloaded, that they should start reversing. And then the last is the market discounts everything. This means that all of the sentiment, all of the is going to happen, would be happening, could be happening, is already factored into the price. In other words, when Janet Yellen and the Federal Reserve raised rates 2 weeks ago, the market had already accounted for it and already factored it into the price of the assets. So the belief in technical analysis is that everything that could have, should have, and would have happened is already factored into price. So therefore, a true technical analyst or a hardcore technical analyst doesn't look at news, doesn't look at headlines, doesn't look at economics data. He looks only at his charts because he's not concerned as to why something happened, only that he can see in a chart that something happened, and he wants to see how the price is reacting to what happened. So technical analysis is widely used among traders and financial professionals, as some studies say its use is more widespread than fundamental analysis in the financial markets. Technical analysis is a methodology that makes buy and sell decisions using market statistics. It primarily involves studying charts, showing the trading history and statistics of whatever security is being analyzed. But it all wraps up into market psychology and emotions. Technical analysis tends to remove your emotions from the market. You're not listening to Janet Yellen's press release or Mario Draghi's press release and getting wrapped up in it. Look at it. He's saying the Eurozone's recovering. He's going to be cut, and I'm going to go trade the Euro going up. You're leaving all that behind. To perform technical analysis, investors start with charts that show the price and trading volume history of a particular security or index, as well as a host of other statistical measures, such as moving averages, maximums and minimums, and percent changes. The idea is to use the chart to identify trends and changes in those trends. There are several kinds of trends and patterns, some with unusual names like rectangles and triangles, Bollinger Bands, inverted head and shoulders, candlesticks, MACD, histograms, stochastics, and so forth. Some technical analysts also use indicators and oscillators to interpret trading data. Now the fact is, technical analysis can be as complex or as simple as you want to use it. Okay. I personally don't believe on either side of these entirely. Now there's all types of black box or algo trading system and robotic trade that's only used and all done with only mathematical calculations and algorithms, and therefore it becomes technical analysis. I think any of us who are trading in the world of retail trading need to use a combination of both. Okay. And you can make it as simple as you want, like I said. But the fact is you need to know that an economic event, such as a speech from Mario Draghi or unemployment for the Eurozone or the jobs data is coming out, because all the technical analysis you've done might not or might be ruined by that report, or that report could cause a short-term volatility in the market, and therefore you couldn't ride out that volatility because you couldn't afford the swing of the marketplace. Because you've got to, no matter how you trade, you got to protect your risk by placing stop losses. So if everybody was expecting, say, when we had the price increase in the Federal Reserve, we were expecting what they call a dovish increase. I mean, we got the increase, but it wasn't wholehearted. But what we ended up getting was the increase and a much more hawkish statement from the Feds, which did the exact opposite. Well, it sent the market up and sent the market down and going both ways and caused volatility at the moment. And if you were completely right about where the dollar should have ended up or gold should have ended up, but you couldn't afford to cover that volatility, you got stopped out when the market swung all the way back down, even though it ended up right where you had put your take profit point, where you had decided it was. But that interim volatility killed you. Now, also, you can't kind of not trade with technical analysis because you don't know where to put your stop loss. You don't know how volatile the market is without looking at charts. You don't know where the next support or resistance levels are. And how do you decide where you would legitimately take profit? Not that I think Apple's at 146 and go to 150, so I'll sell it at 150. That's just a shot in the dark. Because maybe it's only going to go to 149.75 and you missed the whole thing. Okay. You're only going to get that with technical analysis. So technical analysis is like building your roadmap to success. And you need to start off with a proper foundation. And that proper foundation is learning to use your charts. Learning to read your charts. Because you can't put any of this stuff on anywhere else. You can't use it without being able to read a chart. So unlike fundamental analysis, while it focuses on a security's true value by understanding financial statements, market outlooks, competition, technical analysis is based on the belief that past market trends can predict the future behavior of the market as a whole. So now, tonight I'm not going to teach you about charts because we have whole classes, and it takes at least a 1-hour class to teach you the differences in the different types of charts and how to set time segments and how time frames and how to use the indicators and oscillators. But tonight we're going to look at the charts because the charts are what you read for technical analysis. So if an investor can correctly interpret a chart's message and predict a security's movement, he or she can obviously make a lot of money. Certain aspects of technical analysis are controversial, such as the belief that market moves and trends that can play out over a long period of time, and the contention that market action can detect shifts in supply and demand relationships. But technical analysis believes that the investors en masse display much of the same behavior as the investors that preceded them. To a technical analyst, the human characteristics of the market might be irrational, but nonetheless they exist. because investors' attitudes often repeat. Investors' actions in the marketplace often repeat as well, i.e. patterns in a price movement will develop on a chart that a technical analyst believes has predictive qualities. Now, let's say, okay, and we're just going to say, make this up because I'm not giving you any trading advice to go trade something. So we're not looking at an asset at the moment. But let's say gold is moving to $1,300. Now, $1,300 is a critical psychological level for gold. Now, several things are going to happen when gold moves to $1,300. Gold's going to move up to $1,300 once it hits that $1,300 level, or we saw it last week with Bitcoin. Bitcoin hit 1,300, and what it did is it triggered huge amounts of sell orders. And lots of traders who had entered Bitcoin at $700, $900, $1,200 had said, okay, if it ever breaks 1,300, I'm going to sell my contract. Well, because that sell point was, or that take profit point was already built into their trading, or big hedge fund managers and big computer systems had already developed this, decided this, as the price broke that strategic level, it triggered sell orders all over the world. Well, when it's triggering those sell orders, what's happening is the price is easing back down. Because if there's only so many buyers at $1,300, the price bounces off that $1,300, goes back down to 12, say 95, 94, 93, and then moves up to the $1,300 level again. Again, it triggers some other order. Then it triggers some people that were manual, some other people that sat back because they thought it was going to break through 1,300, and they saw it move up, and they sold it as it got close to 1,300, because most people were happy. If you got in at 12 and it hit 1,300, you stayed in. Other people were now starting to say, well, maybe it's going to have the momentum if it hits 1,300 again to bounce through it. Okay. But it did. It got to $1,300 again, and there was not enough buyers, but there was more than enough sellers, and it went down. What did it just do? It formed a pattern that we called a double top. It also hit a strategic resistance level, and it formed patterns on a chart. And we could use those patterns to start making decisions. And so we have something called a double top that has a certain interpretation on the chart. And then we have a triple top. And then if you're using Japanese candlesticks, there would have been candlesticks that would have also helped you make your decision. So before we go on, let's go over, and I've got a couple charts set up. And let's take a look at these charts and see if we can see not how to make trading decisions, see if we can see how the use of technical analysis can help us. Okay. Now, in front of you, as soon as it pops up, there we go. We have a very, very simplistic chart, but it's a chart, so therefore it's using technical analysis. But it's a chart using a trend line, and trend line by the rules, and if you're not exactly sure how to build a trend line, then you need to come to our class, The Trend is Your Friend, and we'll teach you all the rules about drawing trend lines. Somebody out there keeps writing and saying they're not seeing any charts. If you're not seeing a chart, it's your computer system. You need to hit the refresh button. And if you're still not seeing it, sign out and sign in. It's just on your side that it's not changing. Now, what you see here is a very simple trend line. And on a chart, you can see that price moves in what we call thrusts and ease. A good trend, you see price move up, thrust back down, price move up, thrust back down, price move up. And at no time could it break this trend line. When it did, it signals the end of that trend and the beginning of a downtrend. Now, a combination of using candles, we have a very specific candlestick pattern here. We could have predicted at this point if the trend was over. We also had a solid support line here. When we saw it broke that support line, we're now predicting, and this is a current chart, for it to come back up to this support line, which now became the resistance line, and bounce off of it and head down, and then we should see the Australian dollar falling down and coming down. And so this is helping us get entry points and making trading decisions. This is a very simplistic way of using technical analysis. But since it was all on a chart, it is all technical analysis. Now, a lot of this has to do with the Reserve Bank of Australia meeting last week and some press release, statements coming from the Reserve Bank. No, I think the Reserve Bank is meeting this week. And we think that the Reserve Bank is going to talk down the Australian dollar because it's trading way too high. We're not going to expect them to make any change, but this is the market factoring it in ahead of time. Now, we can go over here to a chart for UK oil, and this chart is a wee bit more complicated. Here we're using a 5-point wave, and we can see once again that we have a beautiful wedge coming down, okay, which is a chart pattern. We have our 5-point wave down, up, down, up, down, up, and look at that, beautifully staying on this trend line. And now we're predicting on the wave patterns, okay, where price should go and then where it should be expected to move later. So since our strategy or our philosophy is to trade with the trend, okay, we would trade from here because that would be starting a downtrend and it's over and all a downtrend. We would trade it going down. So you want to combine this with other things like candlesticks to look for entry and exit points. But this is simple trading from technical analysis. But then we can go over to much more involved technical analysis, and it's again completely up to you, or you can keep adding onto your charts. Now, here is gold, and we can see it's got multiple moving averages. We can see it's using MACD histogram down below. It's also using RSI to do all types of calculations based on price movement. So this person, and this was not my chart, I took this offline for you. This person uses a very complex group of 10-day, 20-day, and 50-day, 200-day moving averages combined with volume, combined with MACD to combine with RSI. So he's using indicators, oscillators, moving averages, chart patterns, as well as using Japanese candlesticks. But again, all of this is done on charts. So this is all part of technical analysis. So again, it can be as complex or as simplistic as you want. So let's go back to my PowerPoint for a second. Okay. So whether technical analysis is really useful is a matter for some dispute on Wall Street. Some investors believe that it's impossible to forecast the market's ups and downs. Academic studies have shown that when most people, professionals and amateurs alike, try to move money in and out of stocks to beat market fluctuation, they tend to wind up with losses. Some academic studies say technical analysis has little predictive nature, but other studies say it may produce excess returns. Well, the fact is, I don't know, and I'm not sure how much I believe in technical analysis telling you what to do and where something's going. Technical analysis to me gives me a direction of an asset. It gives me points of interest on a chart. It gives me price levels that I might expect an action or reaction to help me make my determination. It helps me set my support and resistance levels. It helps me see entry or exit points. And at the same time, it helps me see the volatility in the market, because ultimately trading is about minimizing your risk and maximizing your profits. And that you can get, you have to combine a winning or positive or good risk management strategy along with money management strategy, which becomes part of a trading plan. Okay, and this is what ultimately together will generate profits for you, not simply using technical analysis. So, but we'll learn by starting to put some basic information on a chart, because there are 3 pieces of information that should be part of everybody's chart that I don't call technical analysis. They fall in the field of technical analysis because everything is on a chart is technical analysis. But there are 3 lines, so to speak, that every chart should have and every trader should be looking at no matter how you're trading, because they're like your foundations. They might point out a mistake in what you may be doing. And this is number 1, a trend line. Number 2 is support and resistance. And number 3 is volume. Because volume will help you determine if the markets believe in the price, that the direction the price is moving, and how strong the volume is. Because if price is moving up and you see lots of volume, that means lots of traders moving the market. That means they're supportive of that move upward. And a trend line helps you just determine in which direction the price is moving. And you have long-term trends, short-term trends, medium-term trends. And then you have areas of support and resistance. These are the congestion above and below the prices. These are the prices where in the past traders had hemmed and hawed, because price doesn't just move in a direction. So when we saw Bitcoin or gold moving to $1,300, we knew $1,300 was an important resistance level, because never in the past had it ever broken through that 1,300 level. And before that was a 1295 level, because the one time it had come close to coming to 1,300, it petered out at 1295. So once price moved over that 1295, that became a support level, and your next crucial number was 1,300. Well, that was easy on Bitcoin because it's never been there before. But the Euro US dollar, which is trading, I don't even know where it is today, 112, 111, 108, I have no idea where it's trading, has been at all of these prices before. And you can see where buyers have hemmed and hawed. It just gives you a framework. It's like the floor below your feet and the ceiling above your head. And you're in an elevator. It can still move up and down, but it gives you some type of idea when price is moving, where it's trading now, where the traders might act or react. It's not saying when prices hits that resistance level, it's going to bounce off it. It can go right through there, but at least it says, okay, 1295 is an important number. Let's see what the traders are going to do at that 1295 level. If they support it, and the price bounces off there and starts moving up, that means the traders strongly believe that support level. And where is it most likely going to move? Or when Bitcoin starts tumbling or gold starts tumbling from 1,300, tumbling down, okay, it can fall right through each floor, but something will help us predict where when it's falling, okay, well, 1295 is a support level. It fell right through well, what's the next support level? And what's the next one? Because these are historic levels. These are prices when the asset traded this level before, where the buyers hemmed and hawed, and you had lots of congestion. So all they do is help you start building your roadmap to success by giving you a better foundation. So if you imagine that your chart is like a roadmap or an atlas. Now, I know a lot of you guys are young and you've never used anything but GPS. But when I started driving and I started doing business, We didn't have GPS. We didn't have computers. And we had road atlases and maps we kept in the glove box. Well, I was the kind of guy that I'd pull out the road map and I'd look at the major highway and I'd find the major line off of there, and I'd analyze whether it was rush hour, how long it should take. And believe me, I spent lots of time on the side of the road trying to pull out that map or in filling stations asking for directions. But at least I was on the right highway in the right direction. Well, this is your trend line. It's giving you that right highway in the right direction. Your support and resistance levels are like your exit lanes, your exit, or where you want to get off if traffic's backed up or there's an accident or roadworks. It's not telling you you're still going in the right direction, but you might hit some works along that road. And what's volume? Volume is the amount of cars on the highway. So you know it's rush hour. There's lots of volume. They're all going home to the suburbs. But then you get to more complex stuff. Simply determining what type of chart you want to use can affect your analysis. And there are many different types of charts, but we have classes on introduction to charts, and we'll teach you the difference between a line chart, a bar chart, and candlestick. We have whole classes in candlestick chart where we'll teach you how to use and read and understand what candlesticks are trying to tell you on a chart. And this works very good at helping you develop a trading system. Because the more detail you add to your maps, the more likely you're not going to get lost. And that's all these do, is they help you not get lost. Because like I said, without combining them with a trading plan, some hardcore money management rules, you'll still not do well. But as long as you start at the basic building blocks and a good foundation and add on the right things, like why do you have car insurance? Okay. Why do you have roadside assistance insurance? All of these things to help you when you're moving along the way. Okay. So your risk management is like your car insurance. Your money management is like your roadside assistance. You need all of these to make sure you're doing the right thing. But you can add these on over time. Okay. You don't have to start out knowing everything. And you can keep adding and adding on to your trading system and your knowledge. I mean, if you come to my house, in my office here, there are strategies all over the world. There's charts all over the place. There's reminders all over the place. And I never start a trade without having a trading plan. Not a trading strategy, a trading plan. And I do things by hand. So I write it out, everything. And it's the time of day I'm going to trade. Because you'd be surprised how important, not just trading, but the time of day you want to trade. How much you're willing to risk per trade. How much you're going to risk on where your exit point is and where your entry point is. Where those figure out your risk management. Say, if I'm only going to enter a trade where I have 3 times more possibility of profit than I do of risk, because I know I'm not going to have every winning trade. But if my profitable trades outweigh my losing trades, I end up making money. So guys, on that note, I'm going to say goodnight to you. We have a whole bunch of new classes coming out for you in August. We have a whole new semester. I've just sent them into compliance for approval, so as soon as they get them back and approved, we'll be putting them on the schedule. We have a nice schedule in July, and then August we are changing times because lots of people will be on vacation. And then in August, September, we'll be launching all the new classes. So watch for those all on the schedule. And we have a lot of exciting classes coming up. I spent a lot of time. We have a whole class on MACD. We have an entire class on Bollinger Band strategies. We have a new class called Mastering Trend Trading, more precise, that will help you build your trading strategies. So I will talk to you later in the week. And thank you very much for joining us. And if you're getting on a holiday, enjoy the rest of the summer. And unfortunately, I don't get holidays. I'll be teaching you through the summertime. And just watch for all the new classes coming in August. Thank you very much, and have a great trading day. And thank you very much for being part of the ETX family. Good night now.